Rohit Kulkarni is Managing Director and Head of Research at SharesPost. He joins us live from San Francisco. Rohit, it's great to have you on this morning. So let's start with the big one we are expecting perhaps next month, Xiaomi.
Hey, thank you, Kiko, and thank you, Bernie, for having me. Yes, it's a very good time to be in the Chinese venture capital ecosystem, if you will. As in, I would put this as we are at the beginning stages of the third wave of innovation of the way Chinese companies are accessing global capital markets. The first wave started way back, Tencent, Baidu. Second wave was around Alibaba, JD. Every wave is bigger than the previous one, and no surprises here. The next wave, Xiaomi is just at the beginning, and I think it's going to be much more bigger than what we saw previously, as in terms of both value creation and wealth creation for investors and employees alike. So very exciting times in Chinese venture capital ecosystem.
Rohit, are we not hitting some possible fatigue in the market with the willingness of people to throw all kinds of crazy amounts of money at these companies? The latest buzz or some of the talk has been this Xiaomi thing will need to be shaved back when it happens from 3 digits down to 2 digits, say 80 billion, 90 billion. I realize that's still a lot of money, but you know, the willingness of people to throw money and on a prayer like they might have in the past seems to be long gone right now. People are becoming a lot more discerning, a lot more discriminating in the best sense of the word.
Yes, of course. As in, investors are, of course, more and more discerning with every new IPO that they come. They are learning with all the puts and takes, with all the companies coming through the pipeline. But the IPO market here in the US and globally couldn't be hotter. As in, this year itself, we have seen more unicorns go public in the US than what we have seen in any of the prior 3 years. So just in May, through May, we have seen more unicorns go public. Also, the pricing and the price increases have been tremendous. As in, Dropbox was a big down round IPO at one time. Spotify was something that people were very worried about. So the point is, IPO sentiment and receptivity is very good. As far as Xiaomi and what valuation they would be able to get, I think it's a play, it's a song and dance that we will see until we actually see the price on the cover. Again, we read through the 600-page document. It's a massive, massive document. It was I would recommend every investor here in the US or anywhere to essentially skim through it if you want to read up on Chinese ecosystem as such. But the point is, what Xiaomi is trying to tell the story is they are more like a Tencent and less like a Samsung or Apple. If investors believe that, then this is a very, very successful IPO. If investors find it somewhere in between, then you're talking about the numbers that you just mentioned, somewhere in the range of 70 to 80 billion dollars. So again, we will see a lot of song and dance next couple months, and
Rohit, you say the IPO sentiment is strong in the U.S., and yet when you look at some of the more recent Chinese tech listings, they haven't seen the kind of success we saw from something like an Alibaba many years ago. I wonder, on this side of the world, we've seen the listing rules being changed to try and attract these big Chinese tech unicorns. Who's likely to benefit from all these companies going public? Are we going to see all the listings move back over here to Asia?
I think Xiaomi is probably the first and the biggest one that is going to test these changing of rules, so where you have dual class shares and you have 1 or 2 people having exceptionally high level of voting rights, and the recent changes in the rules in Hong Kong Stock Exchange helps companies like Xiaomi and helps Hong Kong to pull back all these listings. Also, over the years, having followed many of the Chinese IPOs on NASDAQ or NYSE, there is an inherent kind of discount of kind of the unknown, as in US investors tend to apply that to Chinese companies. So I believe the big winner here is Hong Kong Stock Exchange, as probably the biggest lesson they had since Alibaba that you just mentioned, Akiko, is the dual class share structure, and kind of relaxing those rules is probably going to help a lot of mainland China unicorns over the next 12 to 18 months.
Do you worry about do you worry at all about the changing structures here in the markets? Rohit, they're also enlarging the quotas or the amounts that can go through the connective programs. The fact is, it's been a very rare day when we've actually seen some of the connect quotas actually totally used up. I just kind of wonder if cheerleading a bit and saying, hey, look, we just enlarged the program in and of itself is going to create that kind of buzz, going to create that kind of capital flow.
Yes, I agree with you. As in, it's still early days in that I would think that way. Also, there is a value for overseas companies, both from a branding and kind of investor stickiness standpoint, to kind of attract overseas investors. So there is always those things to consider for companies when to choose the primary destination to list as such.
Right.
Rohit, very quickly before we let you go, we know the big names to follow: Xiaomi, Didi, Meituan Dianping. Any others that you're watching that you think could actually surprise to the upside when they actually go public?
Just yesterday, I think one of the kind of state-owned the towers company, as in it's towers companies in the U.S. are trade at a significant premium. Probably that's something to watch, and probably they are also taking advantage of the Hong Kong listing rules. So that's China Tower is something that we would keep a close eye on.
Okay, we'll have to leave it there. Rohit, it's great to have you on this morning. Rohit Kulkarni joining us from SharesPost over in San Francisco.